Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. It was a whipsaw for investors as President Trump calls off tariffs on Europe. Stocks closing near the highs of the day. We're digging into the market action. Plus, a major transition is coming to Walmart. CEO Doug McMillon handing over the reins to John Furner. We have a closer look at what he needs to do for Walmart to keep up its momentum. And JP Morgan CEO Jamie Dimon warning of an economic disaster, all because of President Trump's proposal to cap credit card interest rates. We look at the implications for borrowers ahead. Well, Walmart is preparing for a leadership transition. John Furner is set to take the reins from Doug McMillon effective February 1st. Our next guest lays out three priorities the new CEO needs to maintain Walmart's success. More, we're bringing out Jerry Storch, CEO of Storch Advisors and former CEO at Toys R Us and Hudson's Bay. Jerry, it is always good to see you. So before we get to the priorities, Jerry, maybe just start with John Furner. I'm just curious, Jerry, listen, does he have just the right pedigree, resume and experience, Jerry, in your opinion, to lead Walmart forward?
Well, sure. With Walmart, you can't really bring someone in from the outside. So he's been brought up in that culture, understands the business at a micro level, and so and they've been performing, very, very well, by the way. So it has to be an insider, and he's a star there.
You say in terms of his priorities, let's walk through these, Jerry. What should be John Furner's priorities? Well, one, you say build and motivate the team both at headquarters and the field. Why is that a priority, Jerry? And then walk me through, if I'm an investor, how am I charting his success in meeting that priority?
Well, it's a priority because it's always a priority. And it's a priority for long-term management, but it's especially important when there's a change. Right? Because, culture is so critical to Walmart's success. And so you have to make sure you build a great executive team. He's made a lot of changes in his direct reports, his executive team over what existed under Doug. And so that team has to gel at that level and be seen as working well together and reflecting both the history of Walmart as well as the future. And then all throughout the organization, a key to Walmart is how it works in the store and what the culture is like at that level. So you have to sustain that going forward. It's been, I would say, one of the pillars of the company since Sam Walton started.
Another priority, Jerry, you say, continue to innovate. Now, what do we mean by that exactly, Jerry? I assume, do you mean continue to leverage AI across the business?
Yeah, absolutely. That's exactly what I mean. This is the most revolutionary change since the internet, and that was probably the most revolutionary change since the steam engine, and that was probably the most revolutionary since the printing press. So they have to embrace AI in everything they do in the business, both customer-facing as well as back of the house. Certainly, they understand this. They talk about it all the time, and Furness was recently on a panel with Google talking about this at the National Retail Federation conference. So they get it, but now they have to make it real. It's one of those things where it's a little bit like teenage dating or something. Everybody talks about it, but most people aren't really doing it. That's where AI has been for a long time, and now it's starting to change. It's starting to become not just something you sort of know you have to do, but not sure what you have to do, to something you better be doing and know exactly what you're doing going forward. And so that's why they have to focus on it. It's the future in every business, not just retail.
You also, Jerry, you talked about Walmart perfecting, you say, its all-channel business. Now, for those of us who don't follow maybe Walmart and retail as closely, Jerry, what are you referring to there when you talk about the all-channel business?
Well, I'm talking about that they both sell in the store where 80% of retail still occurs, as well as have an excellent internet business or e-commerce business where the other 20% takes place in the economy as a whole. They have done a wonderful job. They probably have the best developed sort of all-channel model of any retailer where you can buy online and pick it up in the store. You drive up there and they put it right in your trunk. My wife and I do that for groceries all the time. Or they'll deliver it to your house from the store in your neighborhood, or they'll send it from a distribution center to your home or to other places. So they use all different channels to deliver product to you and leverage the fact that they have bricks and mortar to make it a competitive advantage. And that, frankly, has been something Amazon has been struggling with, trying to figure out, well, they got the internet part right, the sort of old-fashioned direct mail home delivery model, but the rest of it, the store-based part or the go pick it up part, they've kind of stumbled on. So, but that's something Walmart's had going for them, and they need to keep leveraging that advantage that they have over Amazon, who's the biggest threat to everyone.
Well, let me ask you about Amazon, because there was this story in the Journal, Jerry, I don't know if you saw this, but how Amazon is opening its largest ever big box store. And I'm curious what you make of that. If I'm a long-term Walmart investor, Jerry, is that a long-term risk on my radar?
I don't know. I think they're at least getting closer to what they need to do with bricks and mortar. It's funny. I've been working with Amazon since when I was at Target. We did the first big deal between Target and Amazon. I did that with Jeff Bezos, where we were linking them together. And it's funny. They never really asked. Maybe they just lift up the phone and call. Like, how should we do? All channel model, because everything they've done has been, in my opinion, incorrect. So they bought Whole Foods to get into grocery. That was ridiculous. Whole Foods is not a general grocer. As you know, it's a very high price, kind of a niche player originally, more in the healthy, health food type direction. They should have bought Kroger or Safeway or someone like that if they're really serious about getting the business. And then they keep trying to deliver groceries from everywhere except where they should come from, which is from the store around the corner. And Whole Foods doesn't have a store around the corner for most people in this country because it's too small and doesn't cover the country. So that model, that is the ultimate way to deliver groceries, doesn't work. So, and then they try these small stores, Amazon Fresh or whatever, these little tiny stores. That doesn't work either because no one likes little tiny stores. They should ask the customer what kind of store they wanted. What customers love is hypermarts. That's what Walmart's doing. That's why they're so successful. So this big store they're talking about building, I think the first one's in Chicago, a suburb or something like that, that's starting to make more sense. Where the store's got what you want to buy in it, which is pretty much everything in today's world in a hypermart, and they can use it as a distribution center for that all-important, all-channel model we talked about with Walmart.
Finally, Jared, I just want to squeeze one last question here, because we're talking Walmart, but Target, now they have a new CEO there too, right? Michael Fidelki. What do you make of him, Jerry, and what should his priorities, do you think, be in 2026?
Well, they're in a little different situation, because unlike Walmart, they haven't been doing so well. So what we're all looking for there, and I'm sure the market is change in direction. Walmart's been doing great, so we're looking for innovation. But at Target, they're going to figure out how to win, because right now they have not been winning. And so the big knock on him is not that he's not a smart guy or a good guy or a company insider, but will he create true change? Because change is desperately needed there if Target is ever going to close any of the ground they've lost versus Walmart and versus all other retailers, as their sales have continued to struggle, while Walmart and Costco and TJX and Amazon have thrived.
Jerry, always great to have you on the show. Thank you.
My pleasure.
Stick around. We bring you the biggest takeaways from the day's market action. That's next. Stocks spiking, reversing from steep losses in the previous trading day. The move higher follows Trump's announcement of a framework of a future deal with respect to Greenland. Yahoo Finance's Jared Blikre joined me now with the trading day takeaways. Jared.
Thank you. Greenland was in the news. That was what was affecting the tape, and that was the tape. It was a land of green today. So let's go through the major indices and some of the minor ones. Here's the Dow up over 500 points, 1.2%. Tech about the same amount. So is the S&P 500. Where it gets interesting is when we get into the Russell 2000, that was up an even 2%. And the S&P 600, which is a different flavor. You got to be profitable to be in that. Fewer stocks, but you got to be profitable. That was up 2.64%. And then the mid caps, that was up 1.76. And by the way, the small caps and the mid caps back to record highs. And I'll just show you a quick year-to-date chart there. There's the S&P 400. That's the mid caps. Just barely eked out the record. And there's the S&P 600 up 8%. And I'll show you what happened in sector land. Everything was green today. Energy in the lead. Do want to show you that the two-day total now still looking at a lot of red. Not for everything, but for the most part, we got some losses to make up from yesterday. But things are pointing in the right direction, Josh.
So what's the big theme, Jared? Summarize it for me.
Buy America. Mm-hmm. It's the opposite of yesterday. And when I say buy or sell America, I'm thinking specifically of the bond market and also the currency, the U.S. dollar. In as much much as stocks. They tend to go in the same direction when we're talking about these things. Here's the the 10-year U.S. T-note yield. That was down 4 basis points to 4.25%. The 30-year down 5 basis points to 4.87%. And the U.S. dollar just up a tad. And everything's going the opposite direction of yesterday. So this is good news because yesterday was looking a lot like post-Liberation Day. And that was kind of a scary time, but things reversed in a snap here today. So everything kind of looking good on that front.
What about the Mag 7? Market concentration, is that still a thing?
Yeah, I had the opportunity to talk to Scott Ladner of Horizon and equal what? And we were talking about the equal weighted S&P 500. So basically, that's where every stock gets one vote instead of the market cap weighted version where you got to be big to play. That's where the biggest stocks have the most weight. So here's the equal weight S&P 500, and you can see it's up 4% year to date. Here's a regular S&P 500, just barely positive. So there is a difference there, and it's a pretty big one. So that just means that concentration, not the issue that it once was, and this has been happening for a few months. And we talked to Scott about some of the trades he likes for this year. He's talking about cyclical stocks, and this is what he has to say about it.
And specifically within that 493, we like cyclical plays. Mm-hmm. So and cyclical plays or cyclical stocks or industries are those which are very sort of levered towards the the nominal GDP growth. So like when things are growing more quickly or inflecting higher in terms of like nominal GDP growth, the economy getting hotter faster. Like those are the types of industries and stocks that we tend to like right now because we do think we're going to get, at least for the first half of 2026, a really kind of run it hot type of scenario.
Run it hot. That episode drops on Thursday, so check it out early.
You want to end here on some crypto?
Let's do it. Bitcoin clawing back some losses here. Let's take a look at the 3-day. You're going to see here's the drop from yesterday. Didn't quite get it done today. In fact, we probed a new low. My thesis. I'm looking for 75,000 potentially. I was talking about a short-term uptrend here. This is just a bunch of sideways action right now. Forget the short-term uptrend. That's just a bunch of sideways. I do think we might probe that $75,000 low before we head up. I'd be very surprised if it's broken though, so that means we're pretty close to a potential big bottom.
All right, thank you.
You bet.
I appreciate it. Stick around. We look at how President Trump's proposed credit card rate cap could impact consumers and businesses. That is next. President Trump proposed the idea to cap credit card interest rate payments at 10% for a year in order to address affordability concerns. JP Morgan Chase CEO Jamie Dimon was asked about this idea at the World Economic Forum in Davos this morning.
It would be an economic disaster. And I'm not making up because our business, we would survive it, by the way. You would, in the worst case, you'd have to have a drastic reduction of the credit card business. I mean drastic, I mean like 10%, I mean like 80%. It would remove credit from 80% of Americans. The people crying the most won't be the credit card companies. It'll be the restaurants, the retailers, the travel companies, the schools, the municipalities, because people will miss their water payments, their this payment and that payment. It would be something else to watch. I think they should test it.
I spoke to Ted Rossman, Bankrate senior industry analyst, about how a capped credit card rate could impact consumers, as well as some tips and tricks to address high interest rate debt.
In theory, people could save a lot of money. The average credit card debt load is about $6,500, according to TransUnion. And the average interest rate's around 20%. So if you make minimum payments towards $6,500 at 20%, you're in debt for 18 years and you end up paying more than $9,000 in interest. This 10% cap would definitely help. Now, it would be only 1 year, and it's apparently something that would need congressional approval. It can't be done by executive order. So there's a lot of asterisks attached to this. The financial industry also says that they would have to cut way back on access to credit if this kind of thing were to pass. So there's a lot of unintended consequences. I actually think a better approach would be to take matters into your own hands, get a 0% balance transfer card, and try to pay the debt off that way.
You mentioned an important point there, Ted. I just want to circle back on it, because that is an argument someone brought up, and you know this, against this. If you have a rate cap like this, so the argument goes, what you're going to really do is restrict access to credit, and I'm curious to get your take on that. One, do you agree with that? And two, if you do, who would feel the brunt of that immediately?
Yes, that's something I've been hearing across the industry, something that would most squarely impact people with lower incomes and lower credit scores. because credit cards are really all about risk management. It's a pretty amazing loan if you think about it. It's this open-ended credit limit that you can use pretty much anywhere, anytime, on anything. Lenders have to price for risk. It's unsecured debt. There's no home or car on the line as collateral. They worry people aren't going to pay them back. And right now, about 3% of credit card balances are delinquent. Another 4% are in charge-off status. So basically 7% are either late or in default. That's their big worry. So I've seen estimates like the Electronic Payments Coalition did a study with the Missouri Bankers Association. They said somewhere between 82 and 88% of credit card holders could lose some or all access to credit if this kind of thing were to pass. 10% is a really low cap. The average is 20. Many people are paying 25, 30, even more. I mean, to find a credit card under 10%, that's a very niche option offered by a handful of credit unions to people with really good credit.
The other thing, Ted, is, I mean, if this happens, banks don't make as much on interest. They're going to try to make that back. And I'm curious how you think they may try to do that. Would it be higher fees, fewer rewards? What do you think?
This would really revolutionize the credit card industry, and not in a good way, I would say. I know we don't want you paying these high interest rates, but like I said, you can pay in full, you can get a 0% balance transfer, you can follow some other payoff strategies, work with a reputable nonprofit credit counselor. I just think the cutbacks would be so severe that if that many people are losing access to credit, well, then what? People need credit for groceries and car repairs, and we don't want long-term debt, but we also don't want you turning to a 400% payday loan. So I feel like there does need to be a trade-off here, and credit does fill a useful role in the ecosystem. So if this kind of thing were to pass, I don't think it will, but if it passes, I just think that there would be huge cutbacks in access to credit. Rewards would probably be decimated as well. Other fees would probably go up. Maybe these big banks who are making less on credit cards would charge more for auto loans, mortgages, bank accounts. I really feel like the effects would be widespread.
Let's say, Ted, I'm a viewer, I'm watching this. I am dealing with, relatively high interest rates. Any advice, Ted, tips and tricks, what I should do here? Should I sit tight and wait to see, hey, how this all shakes out?
I would say take matters into your own hands. Make your personal credit card rate 0. You can pay in full. I know it's easier said than done, but half of cardholders already do that. If you can't pay in full, there are 0% balance transfer cards available for up to 24 months. You could get a card like the US Bank Shield Visa. 2 years interest-free is amazing. Like back to that $6,500 average debt load example, you could pay less than $300 a month for 2 years and be debt-free, interest-free. There's no free lunch. I mean, these cards do have interest rates that go way up after the 0% term ends, but use that time to your advantage, or work with a reputable nonprofit like Money Management International who can bring your rate down to 7% over the next 4 or 5 years and really attack your debt that way. I just think the price control approach would have a real negative set of unintended consequences and would also set a bad precedent for other industries. Price controls don't feel like the way to go.
Ted, so good to have you on the show today. Thanks so much for your time.
Of course, thank you.
That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet.